I went from 3 to 20 properties in one single year without bringing in a partner or without saving up any more cash. And I did it with one thing: equity sitting in a house I already owned. Here's exactly what I'm covering today. Number one, the real numbers behind how I did this. Second, HELOC versus home equity loans, what they actually are and what are the differences. Because most people talk about HELOCs and home equity loans like they're the same thing, and they're not. Three, exactly which banks and lenders to call in the right order. And some terms like lien and equity, and you need to understand these before you start calling the banks. Number four is the honest trade-offs that nobody shares about this exact strategies. What actually are the drawbacks of doing this? And number five, what I'm doing a few years later and whether this worked out in the long run or not. I'll share everything from numbers to the challenges to the realistic perspective on if I had to go back in time and do it again, whether I would or wouldn't do it. Let's start with the numbers. After rehabbing a handful of properties, we hit the same bottleneck most investors hit, especially new investors who don't have deep pockets. They hit the same bottleneck, and that is limited capital. And progress usually stalls at the refinance step of the BRRRR strategy. Limited capital is the single most reason most new investors who don't have deep pockets can't scale beyond a few deals. The goal is to find more capital inside the properties that you already own without bringing outside capital. Here's one property that unlocked everything else. So that's the wall I hit, and here's the actual number that got me past it. Sorry guys, there is some work being done on the studio right now, but I didn't want to lose my chain of thought, so I'm going to record the rest of the video here. Okay, let's go through the real numbers step by step. We had one property that we had acquired as a property to live in. It was bought in an up-and-coming neighborhood, and we had done some work on it, and therefore it had appreciated, but also it had appreciated over time because we held it for a few years. Then when we moved away, we turned it into a rental. It had just a conventional loan on it. This is before we learned how to be investors the way we are right now. I called a lot of local banks and credit unions asking who'd be willing to take a second lien position on this property. Most said no, but one bank came through. Not only did it come through, they didn't even require a full appraisal on it. They just needed a drive-by appraisal. And that was a choice that I made. If I wanted to tap into more of the equity, they would have required a full appraisal. But I actually didn't want to tap into all the equity because I wanted to leave a strong cash flow on this rental. And so because I didn't want to tap into all the equity, they just needed a drive-by appraisal. Okay, let's talk about deploying the funds. Here's a real example from a typical purchase, but I have rounded off the numbers just to make it convenient for you to calculate in your head. Purchase price around $70,000, construction budget around $30,000, seed money that I was asked to bring to the table about $15,000, other soft costs about $5,000. Total cash needed to do this deal around $20,000. Okay, step four is refinancing and pulling the cash out. After rehab and rent, I called a bunch of different banks to figure out how do I pull this cash out. I wanted to find a bank that did not have seasoning requirements. That way I didn't have to wait a long time to be able to get my funds back. I pulled out about $30,000 per property while still cash flowing at about $500 a month per property. Let me find some real numbers and add them to the screen for you to take a look at. Step five is rinse and repeat. I could have paid off the loan, but instead I rolled it into other BRRRRs instead. In fact, the same original loan helped fund a 9-unit acquisition. Now, I've been saying home equity loan and home equity line of credit, aka HELOC, for a while. I've been saying it back to back as if they mean the same thing, and they're not. And this is the part that no one explains correctly. So let's get into what are home equity loans and what are home equity lines of credit. A home equity loan is where you get a lump sum up front, and this has a fixed interest rate, a fixed monthly payment, and it's amortized over an agreed term. You will know the exact payment from day one. Now, a home equity line of credit is a revolving line of credit, similar to a credit card. Draw period is usually 10 years. Borrow, repay, borrow again, repay again, and you pay interest on what was actually drawn. And rates are typically variable. These rates change often, so please check what the rates are right now. At the time that I'm recording this video, they're between 7 and 8%. Now, let's talk about the LTV difference, and this trips people up a lot. What does LTV mean? LTV stands for loan to value. Primary residences can often get financed up to 90% of the loan to value, meaning if the value of the home is 100K, then you can get up to 90K in loan on that home. But rental properties are usually capped at around 75 to 80%. So if the property is worth 100K, it's usually capped. You can only get a loan for about 75 to 80K. Just again, using round numbers so they're easy to calculate in your head. So the question is, which one actually fits a BRRRR? The answer is both work. A HELOC obviously gives you more flexibility because you can draw and repay and draw and repay as you need, and you don't need to pay the interest on the amount that you haven't drawn. A HELOC works just as well if you're rolling the funds into the next deal right away. Honestly, I think that relationship and trust with a lender matters significantly more than anything else here. And what I've noticed is credit unions tend to offer much more favorable rates than anybody else. Okay, let's talk about tax treatment. But before I get into it, here's a quick disclosure. I'm not a CPA or a tax advisor or a financial planner. This is what I've learned with my own experience, and this isn't personalized tax advice. Talk to your own accountant or a professional before any of this. So in terms of the tax treatment, the interest is deductible if you use those funds to acquire an investment property. So if you're taking the money from the HELOC or the home equity loan to go out and buy a rental, then the interest that you're paying on that HELOC or home equity loan, that is tax deductible. It's the same thing if you're using that money to not just buy, but also renovate the property. And this is exactly why pairing this with a BRRRR works so well. Now remember that there is a cap to this depending on your tax filing status, but your accountant can tell you all the details about it. Okay, so now that you know what each one actually is, let's talk about how to even get one. Okay, before I get into that, let me just explain to you what a lien is. So when you bought your house and you got a mortgage on it, that mortgage sits in what's called first lien position. All that means is if that home is ever sold or it gets foreclosed on, that lender is the one who gets paid first because they have the first lien position. A HELOC or a home equity loan sits in what's called a second lien position because it was taken out afterwards. And that lender only gets paid after the first lien is satisfied. So a second lien position is obviously riskier for the lender, which is why some banks, some lenders won't even offer these products at all. So when I give you the steps on who to call first, it's basically me just telling you where I've had the most success first. So call them first, and they will be more open to talking about a home equity loan or a HELOC with you. So step one is to call the bank that holds your first lien position loan, meaning call the bank that already has the mortgage on the property. They already hold the first lien and they already have a relationship with the property, which can make them more open to taking on a HELOC or a home equity loan than a bank that's starting from zero. Second one is call local credit unions next. They're always more open to taking on these second lien position loans because they're based in the community and they're more open to doing that than the national banks. At least that's what my experience has been. And then the last one is call the larger banks like Bank of America. But make sure any of these lenders that you call, make sure you read the fine print because there is a lot of details here and the different tiers and different terms, and all of that matters a lot. Again, here's a disclosure. I'm not a financial planner. I'm not giving you personalized financial advice. This is all based on my own experience by calling the lenders and getting these loans myself. This is not professional guidance for your specific situation. Okay, before you pick up the phone, I want you to be aware, I want to be honest about what parts of this aren't a total upside. Okay, so here are the honest trade-offs. The real advantage is that the interest rate for HELOCs or home equity loans will always be lower than credit card debt. And so the banks do look at them more favorably than they would look at credit card debt, but it does show up in your debt to income ratio. It does take a real hit, and it can impact your ability to get a permanent loan if you have multiple HELOCs because it's going to impact how the banks look at your debt to income ratio. Also, and this is pretty obvious, but leveraged properties, and the more leveraged you are on your properties, they're going to cash flow less. And that's just obvious, but you have to look at what is the upside to getting that loan and scaling your portfolio. Is it worth it or not for you? And the third one is it takes real discipline. When you get that HELOC, when you get that home equity loan, it takes real discipline to not consider that as profit or consider that as money that you can just go out and spend on personal expenses. And it takes real discipline to make sure that you only use it to grow your business. Okay, so 6 years and multiple 7 and 8 figure businesses under my belt, I am not the same investor that I was when I first scaled my portfolio from 3 to 20 properties. I am not the same investor that took out that first home equity equity loan. I'm a portfolio founder now, and I'll say this plainly, this isn't a fit for everyone. This is for people who want to accelerate their financial freedom, and they're genuinely willing to learn how this tool works, not just borrow against their house and hope. All right, so I hope you enjoyed this video. Please let me know in the comments what you found most helpful and what questions